This is level 1 of the CFA program, the topic on economics and the reading on currency exchange rates. Exchange rates are nothing more than the price of one currency in terms of another currency. I'm going to give you the same advice that I give my students. I say to them, look, I know you study hard. I know you study all day. I know you study all night. So at midnight, when you're hungry, you might order a pizza. And that pizza might cost $10. And what you do is you take the $10 out of your wallet and hand it over to the pizza dude, and that's kind of the end of the transaction. However, I tell my students to think in terms of fractions. What you're doing is exchanging $10, 10 US dollars per pizza. So I have them start thinking about a numerator and a denominator. So $10 is in the numerator and one pizza is in the denominator. And you'll see how valuable viewing exchange rates as a fraction will be in one of these first 2 or 3 slides. So let's look at these learning outcome statements. We'll go ahead and talk about nominal and real rates. We'll talk about participants, and then we'll have a series of learning outcome statements about changes in the currency value, appreciation and depreciation, cross-currency rates. Then we'll move on to forward rates and forward discounts and premiums. And then we'll talk about capital flows in the last slide deck or so. Now let's start with this distinguish between nominal and real exchange rates. But before we do that, let's go ahead and look at what an exchange rate is. So before I even get to the top bullet points, look in the light gray box. There's the 1.6459. That's the South African rand, and in the denominator is the Chinese yuan, which is 1. So there's the $10 per pizza. So draw that divided line and have the 1 in the denominator. Now notice on the far right that the rand is the price currency, and then the base currency is the yuan. Base currency is always equal to 1. And so this is how I would read this. I would say it takes 1.6459 rand to buy 1 yuan. Now look at that bottom arrow point down there. This convention might be a little bit different from what you've seen in your undergraduate textbooks, or maybe from some foreign exchange markets that you're used to visiting. So here's the CFA Institute convention right in that gray box. So make sure that you learn it that way. Let's go ahead and distinguish between real and nominal exchange rates. So this thing back here, that 164.59, that's a nominal, that's a stated rate of exchange. Real exchange rates, on the other hand, they consider the difference between the price levels between 2 countries. So let me give you just a quick example. I wonder how many of you are super rock and roll fans like I am. Let's suppose that you wanted to go to a Rolling Stones concert here in the United States, and then the very next day you wanted to go to the Rolling Stones concert up in Canada. So let's think about this. Let's just suppose for some crazy reason that the rate of exchange between the US dollar and the Canadian dollar is unitary. It's 1. So 1 US dollar will buy 1 Canadian dollar. But let's suppose that when you buy your Rolling Stones ticket here in the United States, it costs 100 US dollars. So you have 100 US dollars, you buy that ticket, you go to the concert, and you have a great time watching Mick Jagger jump around. The very next day, you drive up to Toronto and you have to exchange your dollars, US dollars for Canadian dollars. Let's suppose that the price of a Rolling Stones ticket in Canada is 110 Canadian dollars. Well, if the exchange rate is just unitary, if it's 1-to-1, that's the nominal exchange rate, then you exchange your $100 for 100 Canadian dollars, and you're not going to have enough money to buy the ticket. You see the difference between the nominal and the real exchange rate. And so the real exchange rate must reflect the different price levels. Now, of course, I just used the example of one good, right, the Rolling Stone ticket, but you could do this with the index of all sorts of goods in Canada and the United States. So look at those 2 points there. The real exchange rate must incorporate the different price levels between the 2 countries, which of course is going to be reflective of what the rate of inflation is in those 2 countries. Now, of course, the nominal rate of interest, the stated rate of interest, is also known as the spot rate of exchange, which means that you can exchange your dollars for dollars, US for Canadian dollars or any other currency, and you're going to do that immediately. So think about the spot rate is for the delivery of currency either immediately or within the next day or two. Well, sometimes there's a need for individuals or organizations or governments to say something like, you know what, I don't need Canadian dollars today, but I might need them a month from today. So what happens is that these individuals or organizations can enter what's known as a forward contract. And so there are forward rates of exchange that will be reflective of what both parties expect the spot rate to be in, what did I say, 30 days or 60 days, whatever that time is. So look at those forward exchange rates definition. These are rates of exchange for a future date, and that rate is agreed upon today. Now, the cool thing about forward contracts is that if you and I were to enter a forward contract between the US dollar and the Canadian dollar, we would agree on that forward rate. And maybe it's 30 days or 60 days from today, but we wouldn't exchange any capital today. I mean, we'd probably have to pay a financial institution, to write the contract, legal and binding contract, but we're not going to exchange dollars, US dollars for Canadian dollars until that forward contract matures. So who are these foreign exchange market participants? This is a great LOS from a definitional standpoint, because the CFA can say something like, hey, here's a question stem, and which of the following would be characterized as this market participant? And there you have four good possible answer choices. So corporations do this all the time. Of course, companies like Coca-Cola and Procter & Gamble, they get a majority of their revenues and their operating cash flows from outside of the United States. And so there's a need daily, or at least weekly, or at least monthly. And of course, these large corporations, they use the forward markets all the time to exchange cash flows in the Canadian dollar this is called repatriation, to repatriate them back to the home country, or the domestic country. In this case would be the United States. Now, I tell my students all the time, I said, look, if you're interested in the foreign exchange market, go work for Coca-Cola, because they have operations in nearly every country in the world. So you would be up to your ears every day managing and hedging and trying to figure out which currency is going to appreciate and which currency is going to depreciate. And your job is to bring back those cash flows denominated in the foreign currency in the largest amount of US dollars. And then, of course, there's no reason why US investors have to stay on the floor of the New York Stock Exchange or any other stock exchange, or buy mutual funds, or invest in their retirement accounts here in the United States. They can go to Canada, they can go to China, they can go to any other country out there. Governments, of course, as you can imagine, have tons and tons of foreign exchange transactions. And then central banks, of course, because they are interested in, here in the United States, what's the Fed charged with? Trying to have a stable and a relatively low rate of inflation, while at the same time keeping the level of employment at some sustainable level. I think that's the economics term that we use. And so central banks can go buy and sell currencies throughout the world to influence not only domestic exchange rates, but other exchange rates throughout the world. So let's skip back up to the top. So two things. So we have a need for transaction, that would be in the spot market, but over the long term, there's a need for hedging, and that's where you would use the forward market. Now, here's a really good exam question. I ask this all the time for my undergraduate students. Let's figure out what's going on between two currencies. When one currency appreciates against another currency, then that automatically means that the other currency has to depreciate. So we need to make sure that we keep our numerators and our denominators in the right place. So let's go back to that spot rate. What was that from a previous slide? 164.59. Let's suppose that it changes to 1.8356. So look at the rand as in the numerator, right? And so it used to take 164 to buy the yuan. Now it takes 183. So the rand has depreciated because it takes more of it to buy that same unit of the Chinese currency. What is the rate of depreciation? What is the rate of appreciation? And so what you're tempted to do is what you did back in the very first lesson of time value money. Take the future value divided by the present value and subtract 1. And that's, of course, what we did here. Look, we have the 183 divided by the 164 minus 1. So that's just an F over P minus 1. And that gets us 11.52%. But what that represents is an 11.5% appreciation in the, are you ready for this? In the base currency, the currency that is in the denominator. Now, of course, we knew from my previous discussion that the rand has depreciated. So how do we determine the rate of depreciation? And what are you hoping I say? Now, you can see this from the bottom of the slide that it's not what you're hoping. You would hope that the rate of appreciation would equal the rate of depreciation, and you could just put a minus sign in front of the 11.52, but not so fast, my friends. You can't do that. What you need to do is you need to do the reciprocals, right? You need to do the reciprocals, and if you do that, you get 10.33%, and that's the rate of depreciation of the rand against the Chinese currency. Now, the reading doesn't do this, and we didn't bother putting it into the slide, but let me give you a little math shortcut. In order to get the rate of depreciation of the rand, all you need to do is put the 164 in the numerator and put the 183 in the denominator and subtract 1. You get the same 10.33. But readings like to throw reciprocals at you. So you can remember that shortcut or not. Either way, you'll probably get the answer correct. All right, how about cross-currency rates? Remember now, back here, we were just talking about two countries and two currencies, but there are hundreds of currencies throughout the world, and so you might be interested in saying something like, "Hey, I'm a Canadian right now. I'm going to take my Canadian dollars and I'm going to ride a bike. I'm going to ride a bike down through the United States and into Mexico. So you're going to exchange Canadian dollars for U.S. dollars, and then you're going to buy the hot dogs and the hats and whatever. And then when you get to Mexico, you're going to need to convert U.S. dollars to the Mexican peso. And so you might be interested in three different currencies, and that's what these cross rates of exchange are. So here we've thrown in the Russian ruble, so there's the rate 148.76, and then there's the rate that we've been looking at so far, 164.59. What is the exchange rate between the Russian currency and the Chinese currency? And so note that we put the South African rand in red, and notice that one is in the denominator and one is in the numerator. And so all we need to do is multiply here. And that's what we've done in that box, the gray box below. And so notice that the rands, they cancel, and we're left with, what is that, 2.44 rubles per Chinese currency. Now here's just a quick slide making sure that you can be aware of that 1/x button on your calculator. So those of you who don't know about that, just pull out your calculator and find the 1/x button. And so you just put the 2.4484 in there and then hit your 1/x button and you get the 4084. That should be pretty self-explanatory. Moving on to forward rates. We can do this in one of three ways. We can have an outright forward quotation, we can have it in percentage terms, or we can have it in basis points that are either premiums or discounts. Make sure you know this term, basis points. This is what I always tell my students. I said, think about this. 1% is equal to 100 basis points. And then you can just move your decimal over this way or move your decimal over that way to get basis points. And so look at our example down there, converting between expressions. So let's suppose we have that spot rate of exchange, the 164.59, and a 6-month forward rate of a minus 12.7 points, minus 12.7 basis points. So all we do is take that 12.7, keep the minus sign there, divide by the 10,000 because we have all those decimals there, and then we subtract that. So 164.59 minus the 12.7, remember you have a bunch of zeros in there, gives us the forward rate of exchange of 164.463. And if we wanted to express it as a percentage, you do just the F over P minus 1, right? So there's the F and the P minus 1, so that gives you 0.00077. Of course, I can't look at those numbers and not remind myself and remind you, go watch a James Bond movie night, 007, not 0007. Now, remember when I gave you that Rolling Stones concert example, we were talking about real rates and nominal rates. And since then, we've talked a little bit about inflation. Let's go ahead and kind of summarize this before I get to this slide deck. So I want you to think about this. You know, when you go to the foreign exchange market and you say, well, I was able to buy a Rolling Stone ticket for $100 US. Why can't I do the same thing in Canada? Well, what's going to happen is that nominal interest rate is going to adjust. It's going to either appreciate or depreciate depending on whether prices are higher in Canada and whether prices are higher in the United States. So I want you to think about this here. What we're starting with, and this is what the reading does for us, is it starts with some kind of a measure of a default risk-free interest rate. And so imagine inflation being embedded in that default free risk-free rate of interest. Okay. All right, so what does that first arrow point tell us? Since different countries will have different interest rates, their respective spot and forwards are constrained because of the differences in interest rates between the two countries. I mean, think about this. My first example, if the US dollar and the Canadian dollar had unitary relationship 1-to-1, and interest rates, risk-free interest rates, were 5% in the US and 5% in Canada, there would really be no need for anybody in either one of those countries to say something like, oh, I can get a better deal if I invest in a bank or a federal government security in the other country, right? Everybody would be satisfied with their domestic choices. But this is what we know, that interest rates and inflation rates, for that matter, are never identical between and among countries. So what's going to happen is there's going to be an incentive for one country to go and invest in another country's financial securities. In order to do that, they have to pass through the foreign exchange market. Now, when you make that investment today, if it's risk-free, you pretty much know what the future value is going to be, right? If you're in Canada and you come and you buy a U.S. Treasury bill for $9,500, well, you know it's going to pay off for $10,000 in 6 months or 12 months. So you can use a forward contract to lock in a forward rate to return that 10,000 US dollars, which is the future value of your investment. You can return those into Canadian dollars. So the question then becomes, what is the forward rate of exchange going to be? Well, there's a good formula down at the bottom in blue. The forward rate is going to be the spot rate, and then it's going to be 1 plus the interest rate divided by 1 plus the interest rate. So there's that time value of factor that I taught you about back in the time value of money reading, 1 plus the interest rate. And of course, the price currency will be the interest rate in the numerator, and the base currency will be the interest rate in the denominator. All right, so let's focus in here on the differences in inflation. And so we go back to this dude, Irving Fisher, who tells us that, oh my gosh, the primary and driving force with interest rate differentials between countries is going to be their differences in inflation. Now, there are a whole bunch of reasons that might be true, and it's probably pretty close to being true. but it's not perfectly true. But that is not something that we talk about in this reading, but we do talk about it in other readings. So we'll get to that probably in level 2, maybe even in level 3. So we have this concept of interest rate parity, which tells us that the difference between interest rates in two countries is going to be the same as the difference between the spot rate of exchange and the forward rate of exchange. And this is based on the purchasing power parity principle, which goes back to the Rolling Stones price in the United States and the Rolling Stones price in Canada. Purchasing power parity tells us that you shouldn't feel cheated. If it costs $100 to go to the concert in U.S., it ought to cost $100 to go to the concert in Canada. And by the way, textbooks, and including this reading, use the standard example of a Big Mac, because I guess a Big Mac pretty much is a Big Mac, no matter where you go. I guess it looks the same. Although those of you who are fans of Pulp Fiction will know that John Travolta had some ideas about a quarter pounder with cheese in France. So look at that last arrow point down there. Oh, this relationship, the combination of interest rate parity and purchasing power parity, tells us that the investor would come out the same, whether they invest at home or whether they invest in the foreign country and then convert that through the exchange rates, sometimes using spot rates, but most of the time using forward rates and forward contracts. So that goes back to my example that, yes, you feel cheated if you have to pay the higher price in Canada because the exchange rate failed you. Well, that illustrates the relationship and the difference between the nominal rates and the real rates, and then what's going on with forward rates and interest rates. Now, down in that bottom box, we put that formula once again for the forward rate, but look above, basic relationship. So we have a forward premium if the forward rate exceeds the spot rate, and we have a forward discount if the forward rate is less than the spot rate. And so look very down at the bottom there. So forward trading premium is the current forward rate minus the current spot rate. And so here we have just a quick example that satisfies this calculate portion of the LOS. So we have two hypothetical currencies, the beginning of the alphabet and the end of the alphabet. So there it is, 1.6. So the beginning of the alphabet has an interest rate of 7. The end of the alphabet has an interest rate of 5%. 1 year forward rate is 162. So the question then becomes, is that 162, here, and before I show you the answer here, I'm going to go back here. Is that 162, is that an equilibrium rate based on Fisher, interest rate parity, and purchasing power parity? And of course, you probably know the answer right away. The answer is probably not, just because we came up with this example. So let's go ahead and look at what the forward rate is. So let's do the 1.6. There's our spot rate times 1.07. So there's the ABC interest rate, and then 1.05. There's the XYZ. So look, this forward rate of 16305. Remember, that's the theoretical rate. Let me go back here again. That's the theoretical rate that results from all of these equilibrium conditions. Well, the actual forward rate is 162, so there's probably an arbitrage opportunity, and the best way to take advantage of that is to buy the forward contract at that 162, because look, you know it's worth 163. Exchange rate regimes, these are determined by governments and politicians and central banks. So the floating rate regime allows for a free-floating exchange rate. So, that means the exchange rate goes up and down. So all the major currencies throughout the world operate on this free-floating model. And this goes back to the early 1970s. Any of you guys alive in 1973 when United States went from kind of the gold standard of exchange rates to, rates going way up and way down? Look at that second arrow point. So governments may intervene occasionally to influence rates. And I'll go ahead and editorialize here for just a second. Remember, the following 10 seconds will not show up on the exam, but governments have pretty much not been too terribly successful to influence exchange rates over the long term. Maybe short term, but probably not long term. What you can also do is you can peg a currency to another probably stronger currency, and so of course the U.S. dollar is a good candidate to be the currency to which another is pegged. And then of course this requires that government must intervene pretty regularly and substantially to maintain that exchange rate. And typically what happens is that you don't have this pegged rate. You don't have it like, oh, it's got to be right here, right down the middle, but you have this floating peg, so maybe you put a little range in there. Now, the pegged rate regime probably is a pretty small range, like that, maybe even zero. But the reality of life is that it's way tough to make sure that that rate is exactly pegged. And so anybody, any country out there that's using a pegged regime is probably doing some form of this hybrid approach. All right, how about international trade and capital flows? So I want you to think about it in the following terms. And we talked about this briefly in a previous recording. So here I am in the United States, and do you remember this example? I really wanted to buy ice cubes from Canada because they got beautiful, clean, clear water from Santa at the North Pole. So what I'm going to do is I'm going to import these beautiful ice cubes. Canadians, on the other hand, they may look to the United States and say they want something. So we've got imports and exports that are based on all sorts of characteristics. And so let's go ahead and work through these here. The changing price of currency. So look at what we have in bold. Domestic economic trends. All right, so this is just basic supply and demand of capital and of investor and consumers' tastes, right? Supply and demand. Wow. So let's think about what this means is that central banks, they can either increase the money supply or decrease the money supply. And it's probably in response to a trend in the economy, whether they want the economy to expand more rapidly, or maybe they want the economy to slow down, or there's a whole bunch of choices in there. And so foreign currencies change in value just from basic macroeconomic stuff. But then there's going to be a change because of imports versus exports. I mean, think about it. If the U.S., let's suppose that we're in Hershey, Pennsylvania, and Milton Hershey is making tons of Hershey chocolate bars, and Canadians love these Hershey chocolate bars, just like in the United States, we love the Saskatchewan ice cubes. So think about it this way, that if the U.S. sends the exact same dollar amount of Hershey chocolate bars to Canada as Canadians send to the US of Santa Claus ice cubes, if imports exactly equal exports, well, then there probably won't be any effect on the exchange rate. But boy, that doesn't hardly ever happen, of course. So we have these trade surpluses and these trade deficits, and that's going to determine whether or not there is a currency appreciation or a currency depreciation. And then couple that with, look down there, look in the middle diamond point, couple that with the idea that here in the United States, we have changes in income. So if our domestic income increases, we're probably going to buy more Hershey chocolate bars right here from Hershey, Pennsylvania. But we're also probably going to buy more ice cubes from Canadians. And so this is really interesting because you've got U.S. income and you've got Canadian income competing against each other for Hershey chocolate bars and for ice cubes. And so remember it this way. Whenever one of those dominates, then the currency will change. A strong domestic currency will make imports cheaper. That makes perfect sense. And then, of course, what happens then if that we have this strong U.S. dollar? So what are we doing? We're buying tons and tons of Canadian ice cubes, right? We're importing these ice cubes because they're cheap. Well, sooner or later, something's going to happen in terms of what the participants in the foreign exchange market are doing. If they see me coming every day because I'm making a lot of money and my US dollar is strong, well, then what's going to happen is that over time, that's going to change because spot markets are going to change and forward markets are going to change. And so the currency then revalues to some level where it's no longer strong in relation to that other currency. There we go, development of a trade deficit. I talked about that on the previous slide, and then the effect on the standard of living. Those are obvious notions there. And that takes us through the slide deck. I think the most important part here is the first one, and then maybe the third and the fourth and the fifth. So know what the spot rate is, know what the forward rate looks like, know how to calculate the forward rate given, some percentages or basis points, know the difference between spot, forward rates, nominal rates, and real exchange rates, and then premiums and discounts. And I think this is a pretty simple reading, and you ought to be able to do well on questions that come from this reading. So thank you for watching, and good luck studying.